Gold just crossed a line that used to feel almost impossible, and it didn't tiptoe over it, it blasted through it, $5,000 an ounce. Let that sink in, $5,000 for a single ounce of gold. Right in the middle of a world that claims inflation is managed, financial stability is contained, and everything is under control. That story and this price do not sit comfortably together. In the first surge above that level, spot gold briefly spiked toward about $5,100, then held near the low 5,090s, with widely reported trading around $5,091 after the peak. Gold futures tracked right alongside, with a heavily watched settlement near $5,079.70. Those are not normal numbers, those are regime shift numbers. And the critical point isn't the round number by itself. The critical point is what the market is signaling when it pays that much for an asset that produces no cash flow, no dividend, and no yield. Gold is not priced like a tech stock. Gold is priced like insurance. When the premium on insurance explodes, something in the system is making people feel uninsured. This move is happening in a specific environment: rising policy uncertainty, political turbulence, tariff threats, shutdown risk chatter, and the return of headline-driven macro, where a single statement can move currencies, rates, and commodities in minutes. When the market senses that policy may swing hard, or that trade relationships may fracture, or that government funding could become a bargaining chip, capital looks for the most politically neutral store of value available. That is where gold lives. But don't oversimplify this into one tidy explanation. This isn't just inflation. This isn't just fear. This isn't just a weaker dollar. This is a collision of catalysts and market mechanics, hitting a structure that has already been quietly tightening for years. Start with the plumbing, because gold D doesn't move like this without the plumbing mattering. Spot gold is the reference price for immediate settlement in the wholesale market. Think of it as the baseline for large-scale physical trading. Futures, especially COMEX gold futures, are standardized contracts traded on an exchange that reference delivery in a future month. They are often used for hedging, speculation, and institutional exposure. One standard COMEX gold futures contract represents 100 troy ounces. At $5,000 an ounce, that's about $500,000 of notional gold per single contract. That kind of scale matters because it creates leverage and speed. It means a relatively small amount of margin can control a very large exposure. And when the market turns, that leverage can amplify everything, up and down. Now look at the footprint of activity. During this surge, reported COMEX gold futures volume printed around 621,139 contracts in a day, with open interest around 540,587 contracts. Volume is the number of contracts traded. How loud the crowd is. Open interest is the number of contracts still open. How much exposure remains in the system. Do the math to feel the magnitude. 621,139 contracts times 100 ounces per contract is roughly 62 million ounces of notional gold changing hands in a single session. That is not a few people buying coins. That is a global risk market shifting its weight. And here's the thing about weight shifts. They create feedback loops. A breakout like $5,000 triggers momentum strategies that must buy when new highs print. It triggers systematic funds that increase exposure when volatility-adjusted signals flip. It triggers short covering when bearish bets get squeezed. It triggers performance anxiety when managers realize they are underweight the one asset screaming higher. That is how a move becomes violent, because the second wave isn't driven by belief, it's driven by necessity. Then the psychology takes over. Round numbers are magnets. They are also battle lines. Above the number, breakout buyers feel validated. Below the number, dip buyers feel obligated. The market starts treating $5,000 not as a destination, but as a reference point, support, resistance, a psychological border between the old world and whatever comes next. And that is why this matters now. Not because gold is up, because gold is up in a way that forces questions no one wanted to ask. Ask a simple question. Why would the market pay $5,000 for an ounce of gold today? Because markets price risk before headlines explain it. Gold is not reacting to one data print. It is reacting to confidence. Confidence in fiscal direction. Confidence in trade stability. Confidence in the long-term purchasing power of currency. Confidence in the idea that bonds are always the safe place. When that confidence cracks, gold doesn't whisper. It shouts. Now add the technical layer because price behavior tells a story that fundamentals alone can't. A key momentum indicator, the 14-day RSI, Relative Strength Index, has been observed around 79 during this stretch. Classic technical definitions call RSI above 70 overbought. That doesn't mean must crash. It means the market has moved fast, and the rubber band is stretched. Moving averages tell the same story. A widely watched 50-day moving average has been seen near $4,969.91, and a 200-day moving average near $4,761.83. When price is far above these trend anchors, the trend is strong, but mean reversion risk rises. That's the technical translation of it can keep going, yet it can snap back hard. So the chart says two things at once. First, momentum is real. Second, volatility risk is rising. Both can be true. That's what makes this moment dangerous for anyone who confuses trend with certainty. Now, zoom out. A surge like this rarely comes from a single week of panic if the deeper demand structure isn't there to absorb selling. That deeper structure has been building. According to widely cited demand tracking, total gold demand in 2024 reached a record 4,974 tons when including OTC investment. That's the kind of number that suggests broad participation, jewelry, technology, investment demand, and official sector activity contributing. And the official sector, central banks, has been a major pillar. Central bank purchases have been reported around 1,045 tons in 2024, extending a multi-year period of heavy buying. Central banks do not buy gold because of a weekly chart pattern. They buy gold because it sits outside another nation's liabilities. They buy it because it is a reserve asset that can't be printed, sanctioned into existence, or diluted by policy drift. That matters because it can change the character of the market. When long-term buyers steadily absorb supply, the market becomes more sensitive to short-term shocks. It takes less incremental demand to push price higher. It takes less disruption to create scarcity in the available float. The buffer shrinks, and when the buffer shrinks, price moves become sharper. This is where historical context helps. Gold has chapters where it grinds and chapters where it reprices. The repricing chapters tend to arrive when the public narrative says stability is normal, right before stability proves fragile. There's no need to pretend history repeats perfectly. It doesn't. But it often rhymes. Periods like 1979 to 1980, 2008, and March 2020 all had one theme in common. The market began questioning the reliability of the system, currency stability, financial plumbing, and institutional confidence. In those moments, gold behaved less like a commodity and more like a referendum. That is the lens for $5,000. This is not just gold is expensive. This is the market is paying up for monetary certainty. Now comes the part most commentary avoids, the bearish case. Because credibility requires acknowledging what can go wrong. Here's the bearish case, clearly. First, gold at these levels can retrace violently if the immediate catalysts cool. If shutdown risk fades, if trade threats soften, if policy uncertainty is clarified, a portion of the fear premium can unwind. Gold can drop not because the long-term story ends, but because the short-term panic calms. Second, gold is sensitive to real yields. Gold pays no interest. When real interest rates adjusted for inflation, rise, holding gold becomes more expensive relative to yield-bearing assets. A sharp rise in real yields can pressure gold even in a broadly uncertain environment. Third, positioning and leverage can turn against the market. When momentum is stretched, RSI near 79, price well above the 50-day and 200-day averages, profit-taking becomes tempting. Forced deleveraging becomes possible. Margin requirements can tighten. If volatility spikes, traders can be forced to reduce exposure quickly, and that can create a cascade. Fourth, a stronger dollar can bite. Gold is priced globally, and the dollar remains a major reference currency. A dollar rebound, especially one driven by tighter financial conditions, can weigh on gold. Fifth, technical resistance zones can trap late chasers. Above $5,000, psychological milestones like $500 and beyond can become sell-the-rip zones where traders lock in gains. When everyone sees the same level, the market often tests it aggressively. So yes, this can pull back. It can pull back hard. A powerful trend does not eliminate drawdowns. In fact, powerful trends often produce the most brutal shakeouts, precisely because confidence gets too comfortable. Now, here's what those risks don't change. Even if price corrects, the underlying reasons gold is being treated as insurance remain visible. Elevated policy uncertainty, geopolitical tension, and a multi-year pattern of official sector demand. This is where it gets really interesting, because a market can be overbought and still be right. Overbought simply means the move has been fast. It does not mean the premise is wrong. It means timing becomes harder, and risk management becomes everything. So the practical question becomes, what should be watched next? Watch the dollar and real yields, because they often lead the next leg of gold's short-term swings. Watch the futures market footprint, volume, and open interest, because that reveals whether the move is being sustained by broad participation or fading into a thin squeeze. Strong trends tend to be accompanied by healthy participation. Fragile spikes often fade as participation drops. Watch the behavior around $5,000 because that level will act like a referendum. If price holds above it and keeps building, the market is trying to make $5,000 the new normal. If price slices back below it and stays there, the breakout may need time to reset. And keep an eye on trend anchors like the 50-day moving average near the high 4,900 is. In strong uptrends, pullbacks that respect that zone can become reload points for the trend. Breaks below that zone, especially with rising real yields, can signal a deeper reset. Now consider what this means depending on objectives. For long-term holders of physical gold, the key is not day-to-day volatility. The key is the role gold plays when confidence in policy and purchasing power becomes unstable. In that context, the most important variables are availability, premiums, and the long-term thesis of monetary insurance, not the exact tick-to-tick move. For shorter-term participants, this environment is a different animal. A market that can push through $5,000 can also whip $150 or $250 in a heartbeat. Risk is not just direction. Risk is volatility. Entries and exits matter more. Position sizing matters more. Overconfidence becomes expensive. For diversified investors, the focus is correlation. Gold tends to show its value when traditional diversification fails, when stocks and bonds become correlated under stress. In those periods, gold's job isn't to be exciting, it's to be resilient. And for anyone new to this, watch the instinct to chase. Vertical moves create emotional urgency, but markets often punish urgency. A better approach is understanding the drivers first. What pushes gold higher, what pressures it lower, and how it behaves when fear spikes. Because this is the real danger of a moment like $5,000, mistaking visibility for safety. Now, pull the story back together. The headline is gold above $5,000. The deeper story is a market repricing trust. Spot gold around $5,091 after spiking near $5,100, with futures settling near $5,079.70 is a loud message. Elevated futures activity, volume around 621,139 contracts with open interest around 540,587, shows this is not a quiet corner of the market. The technical stretch, RSI near 79 with price far above major moving averages, shows momentum is strong but risk is rising. And the structural demand backdrop, record 2024 demand of 4,974 tons and central bank buying around 1,045 tons, shows there is a foundation beneath the move. Put those together and a clear picture emerges. This is not just a commodity rally, this is a monetary warning flare. And here are 3 things to remember. without hype, without fantasy, and without pretending certainty exists. First, gold above $5,000 signals elevated uncertainty and a demand for monetary insurance, not just acute inflation trade. Second, market mechanics can amplify everything. Leverage, positioning, and risk limits can turn headlines into violent price action in both directions. Third, short-term pullbacks can happen even in a long-term bullish environment. Trend strength does not cancel volatility. It often invites it. Now for the verification moment, because independent confirmation matters. Check the spot price, check the futures settlement, check the daily futures volume and open interest. Compare multiple reputable sources. Verify the numbers, verify the direction, verify the context. And full risk disclosure, because it matters more at moments like this than at any other time. Gold is volatile. Gold can reverse sharply. Nothing is guaranteed. No price level is permanent. Educational analysis is not a promise of outcomes. Any exposure to volatile markets requires careful risk awareness, position sizing discipline, and independent research. Now, one final thought. Gold at $5,000 isn't just a new price, it's a new question. What exactly is the world hedging against right now so aggressively that the cost of insurance just surged into territory that once sounded unreal? Because when the price of monetary insurance explodes, the system is quietly admitting that the world feels less insured. And that, more than the number itself, is why this moment matters.